中国的制造业真的全部要崩盘了吗？
Is China's manufacturing industry really on the verge of collapse? Orders from Vietnam are already booked until June 2025, and India's situation is even more extreme, with orders extending to the end of 2025. Meanwhile, more and more factories in China are shutting down, and a large number of unemployed workers are looking for jobs. In the past, overseas students shopping in supermarkets often saw products made in China, but now many products are made in Vietnam or India. Why is the share of our country's products overseas decreasing? This issue really deserves our attention. Right now, many workers are complaining that they can't make money or find jobs, and they blame their bosses for being heartless. In reality, many bosses are feeling lost too. They've sold their homes and cars and maxed out their credit cards, yet their factories still can't get orders. Is the manufacturing industry really declining?
The man in the video works in the second-hand circuit board business, and he's questioning why the orders are going overseas. Can China ever return to being the world's factory?
怎么感觉临近过年了，好多企业的老板都跑路了？
Many bosses ran away before the Chinese New Year. I'll tell you, a lot more factories are going to shut down by the end of this year. Last year, manufacturing companies were fighting for orders all year, undercutting prices. There's a factory in Huizhou, Guangdong. On the first day, employees were still working overtime, but by the next day, security stopped them at the gate, and the factory announced it was closing. So, the manufacturing industry is really struggling now.
On January 20th, 2025, a vlogger shows an industry dinner. A factory owner in the video says that many small and medium-sized businesses in Guangdong have collapsed, and many companies took holidays early. The owner says, "The trend is here, and at this point, don't work too hard. The harder you try, the worse it gets. Just lie flat. If you have reliable resources to go overseas, that may be a way out, but domestically, we can only lie flat. If this issue isn't solved well, the situation will get much worse, and the consequences will be beyond our imagination." Xu Ruikun, the founder of a Chinese tissue manufacturer, also says, "Many of the business owners I know in the manufacturing industry are either shutting down or running away. A big reason is that they're being owed money by others, which leads to a broken cash flow. There's nothing they can do but choose to run away, creating a vicious cycle." Another vlogger believes that after the Chinese New Year, a lot more factories will shut down. However, he says that after investigation, it's not so easy for Chinese manufacturers to move abroad. This vlogger says that in 2024, the most talked about word was going overseas. Many people thought foreign trade or going abroad was the solution. But after visiting Southeast Asia this year, they realized it's not as good as they thought. Actually, the US and Europe know that most of the manufacturing in Vietnam and Southeast Asia is supported by Chinese businesses, so going overseas is not as simple as it seems. They also said that the domestic economy is bad, no one is making money, it's hard to hire workers, and taxes and social security are rising. Many people are struggling to hold on. After this January, it's likely that even more factories will shut down. China's economy continues to worsen, and the CCP's stimulus policies have failed. The economic downturn has spread from downstream manufacturing to upstream industries. Recently, 60 Chinese photovoltaic listed companies released their 2024 earnings forecasts. Due to more losses than profits, these companies are predicting a combined net profit loss of 55.6 billion yuan. Some media believe that in the context of a down cycle, with both volume and price falling, China's leading companies are losing even more as their production capacity increases. On January 25th, the Chinese photovoltaic equipment manufacturer Goodwe Technology Company Limited disclosed its 2024 earnings forecast, expecting a net loss of 52 to 65 million yuan for the year. This would be Goodwe's first annual loss since going public. Goodwe stated that the sharp decline in overseas sales of high-margin inverters and batteries is one of the reasons for the loss. Additionally, photovoltaic giant LONGi Green Energy also disclosed its 2024 earnings forecast in mid-January, expecting a net loss of 8.2 to 8.8 billion yuan for last year. The company is considered the industry's king of losses. But as the photovoltaic industry's annual earnings forecast near completion, a new king of losses has emerged. TCL Zhonghuan New Energy Technology Company Limited, a leader in Chinese silicon wafer production, disclosed its 2024 earnings forecast on January 24th. It revealed dismal results for this large state-owned enterprise in Tianjin. According to the forecast, TCL Zhonghuan expects a net loss of 8.2 to 8.9 billion yuan for 2024. The company's stripped earnings, which exclude non-recurring gains and losses, are even worse, with a forecasted loss of 9.2 to 9.9 billion yuan. The Chinese website of Week commented that TCL Zhonghuan's strategy of maximizing silicon wafer production capacity and full production has come at a high cost. Although the company's silicon wafer capacity and market share have reached the global top, it has made significant profit sacrifices, essentially losing money to attract customers, which is not a sustainable approach. Based on the current earnings forecast for 2024, TCL Zhonghuan's losses are the largest in the industry. Earlier, several companies also predicted significant losses for 2024. Tongwei Company Limited forecasted a net loss of approximately 7 to 7.5 billion yuan for 2024. In explaining the loss, the company cited a sharp decline in market prices across all segments of the photovoltaic industry, which even continue to fall below the industry's cash costs. According to statistics from Yicai, as of January 26, 60 out of the 96 photovoltaic listed companies had released their earnings forecast for 2024. Except for 5 companies which expect growth, others are predicting their first losses, continuing losses, or reduced profits. Due to the fact that more companies are losing than gaining, the combined net profit loss forecast for these 60 companies is 55.6 billion yuan. Based on the forecasted lower limit of net profits, 33 photovoltaic listed companies are expecting a net loss of more than 100 million yuan in 2024, with a total loss of 63.7 billion yuan. Among them, 13 companies are forecasting losses of more than 1 billion yuan, mainly top manufacturers of silicon materials, modules, batteries, and wafers. As the industry experiences a downturn in both volume and prices, the larger the production capacity of leading companies, the greater the losses they face. Chairman Cao Renxian of the Photovoltaic Industry Association also stated at the 2024 China Photovoltaic Industry Annual Conference that the situation in the industry is extremely severe. He said, "The photovoltaic industry is generally bleeding, with very low gross profit margins and almost no profit." He added, "Some companies are bidding below cost, which is self-destructive behavior." For years, the Chinese government's subsidy policies have led to severe overcapacity in China's photovoltaic industry. Solar energy is one of the most important components of green energy, and solar panels are considered one of the 3 pillars of the CCP's industrial strategy. According to the International Energy Agency, IEA, China holds over 80% of the global market share in each production stage of solar panels, more than double its domestic demand. This large-scale economic effect has made solar energy cheaper, but also resulted in a highly concentrated supply chain in China. The IEA has urged other countries to evaluate their solar panel supply chains and develop strategies to mitigate potential risks. According to data from the U.S. federal government, since Washington imposed tariffs in 2012, the import of solar power generation equipment to the U.S. has tripled, reaching a record $15 billion last year. While there were nearly no direct imports from China in 2023, around 80% came from Vietnam, Thailand, Malaysia, and Cambodia, countries that host factories from Chinese companies. Starting in March 2023, the U.S. Department of Commerce began reviewing 8 companies in these 4 countries that produce solar panels and their components. The investigation found that 4 Chinese companies, BYD, Trina Solar, Longji Green Energy, and Canadian Solar, had conducted small-scale processing in these 4 countries before shipping products to the U.S., thus circumventing U.S. tariffs on Chinese solar cells and panels. According to Reuters, despite waves of tariff measures by the U.S. aimed at curbing Chinese solar companies over the past decade, Chinese solar panel manufacturers have managed to avoid these tariffs by shifting production overseas. Subsequently, the U.S. finalized a decision to impose import tariffs on solar modules produced by these Chinese companies in Southeast Asia. Following complaints from U.S. manufacturers, tariffs on solar exports from these 4 Southeast Asian countries were expanded in October 2024. As a result, some of Vietnam's largest Chinese-owned solar factories are facing production cuts and layoffs. Before leaving office, former President Joe Biden again took action to punish China for unfair trade practices. The White House decided to significantly raise import tariffs on Chinese solar silicon wafers, polysilicon, and tungsten products to protect the U.S. clean energy industry from the impact of Chinese goods. Starting from January 1, 2025, the United States increased the import tariffs on solar silicon wafers and polysilicon produced in China from 25% to 50%. At the same time, the tariff on tungsten products from China rose from 0 to 25%. Both the U.S. and other trade partners believe that the Chinese government improperly subsidizes enterprises' exports, giving Chinese solar panel manufacturers and other exporters an unfair advantage in overseas markets. The government's support allows Chinese manufacturers to compete in international markets at lower prices than foreign competitors. Regarding the ongoing losses in the photovoltaic industry, Taiwan's macroeconomist Wu Jialong analyzed that the root cause is overcapacity, noting that the industry the Chinese government considers the new three pillars of the economy all face this issue. Wu said, the direct cause of overcapacity is first government subsidies, the second is the phenomenon of low waves. The low wave phenomenon refers to too many people copying other successful business models, seeing an opportunity in the field and jumping in. U.S.-based economist Davey J. Huang agrees. He said, first, it's important to understand that China's photovoltaic industry relies on government subsidies to be profitable. Essentially, it's a rush to gain government subsidies because of the government's policy support. Since there are subsidies, they don't focus on reducing costs, leading to low-quality, homogenized products. Huang also mentioned, now both Europe and the U.S. are starting to impose anti-dumping measures, while domestic subsidies are decreasing. When the increase in tariffs surpasses the subsidies, companies will start facing losses. In addition to the photovoltaic industry, businesses across multiple sectors in China are facing massive losses. As of late January this year, more than 900 Chinese-listed companies has issued their 2024 earnings forecasts, and more than half of them expect losses. According to data from Chinese information provider Wind on January 19th, over 900 listed companies had released their 2024 earnings forecasts. Data from companies that have issued earning forecasts shows that as of January 18th, only 22% of companies forecasted positive results, while 54% of companies predicted losses. The top 5 companies with the highest losses are Longji Green Energy, Shouke Company Limited, Wei Company Limited, China Fortune Land Development, and Chongqing Steel. The top 20 companies with the worst performance all have losses exceeding 1 billion yuan. Among the top 20 companies reporting the best profits, the first 7 are all financial companies: China Merchants Bank, Industrial Bank, CITIC Bank, Pudong Development Bank, CITIC Securities, China Merchant Securities, and Changsha Bank. Wind notes that the end of January is the peak time for the release of annual performance forecasts. Among the companies expecting a decline in performance, many are reporting losses of over 1 billion yuan. On the evening of January 17th, Shouke Company Limited released its earning forecast, predicting a net loss of 7.5 to 9.5 billion yuan for 2024, a larger loss than previously expected. The company stated that the loss was mainly due to decreased revenue from property sales and a decline in gross profit margins. In 2024, China's demand for refined oil is also expected to peak. The petrochemical industry is facing severe overcapacity, with both revenue and profits from the 3 oil giants significantly declining. Whether it's crude oil imports, refining volumes, or refined oil sales and prices, all have started to decrease after a period of growth. The National Bureau of Statistics of China recently released data showing that in 2024, China's crude oil imports were 553 million tons, a 1.9% decrease year-on-year. The crude oil processing volume was 708 million tons, down 1.6% year-on-year. These are the first declines in these two figures in over 20 years, excluding the pandemic-affected year of 2022. Longzhong Information, formerly known as China Petroleum and Petrochemical Network, noted that due to high international crude oil prices and weak domestic demand for refined oil, refining profits have dropped significantly. In the first half of 2024, profits from state-owned major refineries and independent refineries in Shandong fell by 23% and 70% year-on-year, respectively. On January 27th, the National Bureau of Statistics released the Manufacturing Purchasing Managers Index for January, which stood at 49.1. This not only fell short of market expectations, but also marked the end of 3 consecutive months of expansion, entering the contraction zone and reaching the weakest levels since August of the previous year. The official PMI for January fell from 50.1 in December to 49.1. A PMI above 50 indicates expansion, while a PMI below 50 signals contraction. Within the sub-indices, both the production and new orders indices fell below 50, indicating contraction. Broken down by company size, the PMI for large, medium, and small enterprises all fell below 50. Data also showed that the new export orders index dropped by 1.9 percentage points to 46.4%, the lowest since February of the previous year, potentially indicating a slowdown in export growth. Apart from the slowdown in factory activity, China's non-manufacturing PMI, which includes services and construction, also fell short of market expectations, dropping sharply from 52.2 in December to 50.2 in January. Another report from the National Bureau of Statistics showed that in 2024, industrial enterprises with annual revenues exceeding 20 million yuan saw their profits drop by 3.3%. Profits from these companies have declined every year for the past 3 years. The new data increases pressure on the Chinese government, which is struggling to cope with the ongoing slowdown in the real estate sector, a loss of consumer confidence, mounting deflationary pressures, and the possibility of a renewed trade war with the U.S.